The Fed is saying there's a whopping 90% chance of a recession. Today I want to talk about what that means for your money, what that means for the AMC squeeze, and what that means for the overall economy. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, David Rosenberg tweeted saying the New York Fed's blog took the words out of my mouth. The probability of a soft landing is only about 10%. He said John Williams is willingly tightening into a recession. As pundits call a bottom, just know it's still a way to go and it's still a way out there. The Fed wants this market to go lower, and go lower it shall. So if we take a look at the New York Fed's blog, it says the New York Fed DSG model forecast for June of 2022. It says this post presents an update of the economic forecasts generated by the Federal Reserve Bank of New York's DSG model. We describe very briefly our forecast and its change since March of 2020. Now there's a lot of jargon, a lot of percentages being thrown around here, but the crux of it says the model's outlook is considerably more pessimistic than it was back in March. According to the model, the probability of a soft landing, defined as 4 quarters of GDP growth staying positive over the next 10 quarters, is only about 10%. And in turn, it says conversely, the chances of a hard landing, defined to include at least 1 quarter in the next 10, in which 4-quarter GDP growth dips below 1%, as occurred during the 1990 recession, is about 80%. Now, it says contributing to that is 2 main factors. The first is a continuation of the cost push shocks that have hit the economy since early 2021, aka inflation, and the second factor is a tighter monetary policy in 2022 and 2023. aka quantitative tightening. Now obviously I'll leave the link down in the description below if you do want to read through all of these percentages and all of these charts, but I think it's just a lot to talk about in a short video. But I think the crux of it is showing that even the Fed believe the chance of a recession is 90%, and therefore at this point a recession is practically guaranteed. They're saying the chance of a soft landing is less than 10%, and the chance of a hard landing, aka recession, is between 80 and 90%. And interestingly, Simon Rhee has also tweeted saying Credit Suisse is issuing debt at nearly a whopping 10%. And he said, I'm surprised this isn't bigger news. So right here we have Credit Suisse being desperate for cash, pricing a $1.65 billion bond at 9.75% interest. So it says the junior subordinated notes are rated B+ or BB, lower than the issuer's rating of BBB or BBB+. Now the first thing there that jumps out as interesting is the fact that Credit Suisse isn't AAA rated, it's not AA rated, it's not single A rated, it's now only BBB rated, and their debt is being priced even lower at BB rated. And Simon Adamson, London's CEO of Credit Suisse, is saying that it's quite a tough sell, even at 9.75% interest. He said the main question is, who wants to buy Credit Suisse paper at all in this sort of market? He said even more recently, Credit Suisse has delivered its 3rd straight quarterly loss warning, further adding to the negative sentiment. I think this goes to show that Credit Suisse are struggling and that even major banks are absolutely desperate for cash now, trying to raise a $1.5 billion bond at nearly 10% interest. You know, this isn't some sketchy company on the edge of bankruptcy trying to raise cash like Revlon, for example. This is a major bank, a major Swiss bank, desperate to raise cash, offering 10% interest. Now, it's not just the Fed calling for a recession, it's not just Credit Suisse being desperate for cash, but we're also setting new daily records still in the overnight reverse repo market. Today, again, we've just set a new record of $2.2 or $2.229 trillion. And guys, if you sign up to Moomoo right now, you can currently get 10 free stocks worth up to $25,000 in total, and a free share of Lucid guaranteed on top of that, just for signing up with Moomoo using the link in the description below. Moomoo is also brilliant for buying those AMC shares because not only does Moomoo not lend out your shares to other institutions, but Moomoo also does not accept payment for order flow. Moomoo doesn't sell your orders to market makers and to clearing houses like Apex Clearing and to Citadel. They actually have their own clearing broker, Futu Incorporated. And as Boss Blunt has tweeted, he said the Fed claims to be tightening, but it's actually increasing the overnight bailout reverse repo program to 1.55% interest from 0.5% interest. So this is actually a new reverse repo facility being created with a limit of $160 billion for now at 1.55% interest, which is significantly higher than 0.5% interest. And he said this helps these short hedge funds because institutions like BlackRock can now lend their securities in the overnight reverse repo market for even more interest. I've spoken many times on the channel before about how the reverse repo market works and how it actually helps these shorts, and it now seems like institutions like BlackRock are just being paid even more money in terms of interest. But again, this is something that can't continue forever. The economy is approaching closer and closer to this recession and to this market crash that will end in liquidations. Now you may be saying, Tom, you've been speaking about the market crash and you've been speaking about liquidations for a long time now. When are we actually going to see some action? And when are we going to see Citadel or other hedge funds being liquidated and going under? But I do think it's something that's been happening on an almost daily basis. The S&P 500 is now down over 20% from its highs, and now on an almost daily basis, if not a weekly basis, we're seeing more and more hedge funds going under. Yes, none of the hedge funds currently shorting AMC, other than Melvin Capital, have yet gone under, but it's almost on a daily basis we're seeing more and more hedge funds going, and therefore it's only a matter of time until those funds that are shorting AMC end up being liquidated as well. As Unusual Whales tweeted, they've said hedge fund Tiger Legatus is also to close after poor returns. But again, it's not just Tiger Legatus, because it's also the quant macro hedge fund ADG Capital that's also shutting down after managing over $3 billion. So in one singular day, that's now 2 more hedge funds that can be added to the list that have now bitten the dust, and I'm sure it's only a matter of time until more and more hedge funds end up being liquidated. It says, according to Bloomberg, citing funds, the statement and March newsletter, the decision to shut down was due to losses and outflows this year. Abdat reportedly told clients the business case has also deteriorated with investor outflows and the strategy itself going out of favour. And Bloomberg stated that ADG Systematic Macro Fund had declined another 13.7% during the first quarter. Maybe the strategy itself that's going out of favour is shorting stocks like shorting meme stocks, which is just causing and compounding more and more losses. At this point, it doesn't surprise me to see another hedge fund biting the dust, and it wouldn't surprise me if we see more hedge funds over the weekend also biting the dust and being liquidated as well. And I think watching the S&P 500 fall, watching these hedge funds being liquidated, and watching these hedge funds maximise their usage of the overnight reverse repo market is giving me more and more conviction in this play. And Peter Han has also tweeted saying why I have conviction in this play. He said 11 months ago, a LinkedIn post of mine went viral. It drew attention from a market maker. He said, like Adam Aaron, I didn't have enough reliable data to go to court. He said, ironically, I was able to deal with it in a way to cause a Streisand effect. He said, what isn't known is that soon after I was under attack by several people on LinkedIn. One was the son of a guy who ran a hedge fund in Chicago. Peter said he attacked me on every one of my posts until I blocked him. He said, I've never done that on LinkedIn before. He said, the other attacks I will discuss at some point in the future. And he said, why did I get so much attention if I was some unhinged noob that had no idea what he was talking about? He said, the play is real, my friends. And I think this is absolutely true. If there was no way that AMC could possibly squeeze, and if there was 0 synthetic shares in existence, why is there so many people not only hating on me, not only hating on Peter Han, but basically hating on every single person in the entire meme stock industry, or hating on every single ape? There's a number of apes on Twitter that experience much worse attacks on a daily basis than Peter or I have ever experienced over the last year. And these are the apes that are the most active, putting in due diligence on an almost daily basis, going toe to toe with the short sellers every single day. And something else that gives me a massive amount of conviction in this play is the fact that Adam Aaron has just changed the numbers on how many shares or the portion of shares that retail investors own. In one of the first earnings calls, you'll remember that Adam Aaron said that apes held around 80% of the float. In the Q1 earnings call, he said that including index funds and including institutional owners, the apes held around 90% of the float. And now Adam Aaron is saying that retail holds 90% 90% of the float, excluding index funds, not including index funds and including investors, but entirely separately, retail on their own holds 90% of the float. And I'm sure when you include index funds on top of that, you include ETFs on top of that, you include institutional owners, and you include those insiders, you all of a sudden have a lot more than 100% of the float. Now, not only does this really show that synthetic shares do actually exist, but it's also showing that retail investors, aka the apes, are still buying AMC shares. In the last few months alone, apes have bought an additional 10% of the float. Now, obviously, including all of those synthetic shares, it's likely a lot more than just 10% of the float, but I think what Adam Aaron is trying to say is that apes are still indeed buying. And also, as Shortlivix tweeted, he said Adam Aaron has contacted the New York Stock Exchange surrounding the amount of FTDs or failed to deliver shares on AMC, and he plans to do it again. Now, I don't know if this is what Adam Aaron means by pouncing in Q2, or if this is what Adam Aaron is actually doing or has actually done, but it does still seem like Adam Aaron is indeed still on our side. Adam Aaron clearly believes in predatory short selling, and he clearly believes in synthetic shares, and that's why he's contacting the New York Stock Exchange surrounding the FTDs. But guys, be sure to let me know what you think down in the comments below. Also, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.